If the 2023 stock market showed anything, it's that you can't predict the stock market. Instead, you need a strategy you can stick with. Art Stein of Arthur Stein Financial joins me now with what the rearview mirror is telling investors. And Art, why don't we begin with your assessment of the past year in terms of the TSP? And I know you don't make predictions, but, what kind of strategy should people be thinking about?
Last year was a very good year, and that was a welcome relief because 2022 was a historically bad year. I mean, not only were stocks down, but bonds were down, in double-digit declines. And it was just, it was very unusual. It was 2 years in a row of bond declines, which almost never happens. It was the first time the TSP F fund and the stock funds had gone down in the same calendar year. And, just looking at financial markets in general is the first time that anybody can remember, maybe since the Great Depression or something like that. So it was pretty discouraging for investors. Then last year, there were a lot of ups and downs, but especially the last two months of the year, everything really jumped, and we ended up, the C fund was up 26%, the S fund 25%, the I fund 18%. And finally, the bond funds went up 5.6%, which is a good return for bond funds and outperformed the G fund for the first time in a long time. So we finally saw what, investors are looking for. And it really benefited people who obviously stayed invested. So if you were a TSP participant who became discouraged and either pulled out of the stock and the funds and the F fund, or whose biweekly investments were not going into those funds, you really lost out. And actually, since the last 2 months of the year contained all the bond fund gains, all the F fund gains, and a very large proportion of the stock fund gains, you had to be in there for those 2 months especially.
It seems like people make the mistake of, if they want to swing around their investments, of taking what's going on in the news and somehow overlaying that with what they think the market will do. And there's been lots of bad news in the last quarter of 2023. The war in the Middle East, the Ukraine situation droning on, the political paralysis in the United States. But the market doesn't necessarily follow those things, which means you're putting yourself in potential danger if you try to beat the market based on the news.
Absolutely. And one way to put it, Tom, is the economy is not the stock market and the stock market is not the economy. And one of the reasons that's true is that the stock market is what's called a leading indicator. It tends to go down before the economy starts to decline, and it tends to go up before the economy starts to recover. And so it makes it very hard to time the market based upon what's going on now. And it's one of the reasons why trying to time the market, trying to get in and out of the stock or bond funds based upon what you think is going to happen has really been a losing proposition.
Right.
The better strategy is just to decide what allocation you want between stock funds and bond funds and then invest accordingly and stick to that allocation.
Yeah, people that have great stories about how they beat the market or time this or that stock sometimes remind me of people who went to Las Vegas and came back, and they never tell you about the losses. They only tell you about how they could do no wrong at the crap tables or something, and you would think that you actually could have a chance of winning at the long term in Las Vegas, which nobody does.
Yeah, and there's actually an academic term for this. It's called recency bias, that we tend to think that whatever has happened recently is going to happen in the future because it's, what we remember most closely.
We're speaking with Art Stein, certified financial planner with Arthur Stein Financial in Bethesda, Maryland. And so looking ahead to 2024, people are, we're here already, and the same wars are going on, the same political paralysis is in the country. And so, the underlying situation hasn't changed because the calendar turned over. So what are you advising people with respect to thinking about strategy for the coming year?
Okay, well, first of all, we have to remember that there is a lot of good news about the economy. Employment's remained very strong, and interest rates have come down a little bit. Inflation has certainly come down, and economic growth has continued. So our economy continues to do well. The general forecast for last year was that there would clearly be a recession. I mean, that was just, most people who forecasted, that's what they were forecasting. And now I'm seeing the same forecast. So the people who keep forecasting a recession, eventually they're going to be correct. Maybe not this year, maybe it'd be 10 years from now, and then they will be crowned the king or queen of forecasting because they got it right. I think a key thing for people to do in the early part of the year, it's a great time to review your financial situation and see where you are and whether you are on the right path. So, of course, you want to look at your TSP allocation with all the ups and downs. I mean, is the allocation what you want? And if not, you can rebalance. Employees, of course, want to look at the allocation of their biweekly investments, which, can be very different than their current allocation. And one thing we often recommend is that your biweekly investments can be much more aggressive than your current allocation because you just have smaller amounts going in every 2 weeks. And if the markets go down, that's good for you at that point because you are buying low. Then another question you need to ask yourself is, do you want to be in the Roth TSP or do you want your money in a Roth IRA? The whole Roth question. So current participants, employees, have the choice of their contributions going either into the regular TSP or a Roth TSP or the Roth TSP. And the major difference is that the money you put in the regular TSP, whatever you put in reduces your taxable income by the same amount for that year. So if you put in $10,000 into the TSP, you're going to reduce your taxable income $10,000. Now, of course, when you take that money out, it's fully taxable. With a Roth, the money that you put in does not reduce your taxable income. But when you take it out, there's no tax on the withdrawals. So you're foregoing a tax deduction on a smaller amount for a tax-free withdrawal and hopefully a much larger amount in the future. One downside of that is that for employees, the reduction because there's no tax break on contributions, your taxable income is going to be higher, and you want to make sure that you can afford that. Now, you can split up, so that some of your contribution goes to the Roth and some to the regular, but people need to look at that, and there are a lot of advantages to a Roth account. For retirees, they can decide to do what's called a Roth conversion, so they can take money out of an IRA and put it in a Roth IRA, but then it's the amount they transfer is fully taxable at the time. That's a much more difficult decision and requires a lot of planning. And it's whether it's a good idea or not depends upon one's personal situation.
Right. So in deciding, though, Roth or regular TSP 401k style, you have to understand, or you have to kind of have an anticipation of what your tax rate will be when you withdraw, presuming
Absolutely.
that it's going to be lower. And if you get some great private sector job where your salary triples when you turn, and you're still working at the age of the minimum withdrawal, then you might have a higher tax than you would have if you'd done the Roth years earlier.
Absolutely. See, especially with the Roth conversion, you have to look at, one, how long do you think the money's going to be invested in the Roth? And, if you're 85 years old, a Roth conversion makes less sense than if you're a 35-year-old employee. And it also makes a difference how aggressively you're investing. If all the money's going in the G fund, it really doesn't make much of a difference. But if you're an aggressive investor, you're putting a lot of money into stocks, into the stock funds, CS&I, and you expect those to grow very rapidly, then it makes more sense.